welcome back to a weekly market recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So this past week, we saw the S&P relatively flat, up 0.06%. We're still down year to date, 4.62%. In the NASDAQ, we saw a little bit more of a rise. We were up 0.65%, but we're still down 8.85% year to date. So if we jump into the market, what we see is we obviously ended relatively flat, but in the middle of the week, we had this pretty big rise up only to peak middle of Tuesday and then really a downward trend up until late Friday, when all of a sudden we saw a rise, fall, and then another rise to end the week. Again, just barely positive. So Rich, we saw a lot of volatility this week. What are some of the things that you saw that were leading to that?
Well, we've had a couple of weeks, 10 days actually in a row of just booming stock market, big rise we've had. So it would make a lot of sense for the stock market to have a couple of down days, just people doing profit taking and profit rebalancing. Also, this is an end of the quarter. And when you come to end of the quarters, you can expect a lot of volatility related to that in pension plans and other funds rebalancing their portfolios. So the volatility this week is not unexpected. Add to that what's going on in Russia and the Ukraine battle and world supplies in both grain and oil. And it's amazing that the week ended as flat as it did, and the volatility in between is not nearly as surprising.
I think overall, it's not necessarily surprising that we've seen this rise, and it's not necessarily surprising that we've seen a little bit of a pullback, because I'd be surprised if we ran all the way to all-time highs. In fact, if we ran all the way up to all-time highs, I'd be a little concerned because we still have a lot of uncertainty in this market. That being said, all the news that we've been getting this past week, it hasn't been worse than expected. Now, it hasn't been great, but it's also not horrible. So let's go through it. The Russian-Ukraine crisis right now, the war, it's looking a little bit like Putin is pulling back some soldiers, focusing maybe more on just the Donbass region. Do we know if that's going to maintain? No. Now, Ukraine has already said their expectation is by the beginning of May to maybe have a complete resolution. Others, the market has been more pricing in the end of May. But right now, we're at least on that trend. Now, are we there? No. So do we have a lot of great news to share right now? No, but not worse news. And so that's okay. When it comes to commodity prices, oil, wheat, we've started to see them actually start to come down. Are they still elevated from when we first started? Yes. Do we have really good news to share? No. Do we have worse news to share? Not really. And so that's kind of starting to stable out a little bit. Now, if we move to what the Fed might do, the market is starting to potentially price in a 50 basis point move for the next hike. In fact, the market is at a 73% confidence that the next one's going to be 50 basis points. Is that good news? No. Is it worse news? Still not really. The market is kind of expecting that interest rates are going to rise. We might have a couple 50 basis point moves. So all of these things are in the realm of not great news, but also not surprising. The market had already been bracing for some of this, and the worst things that we could have seen are not happening. We are not seeing the war escalate to all of a sudden include Europe, nuclear weapons, all of that fear that we genuinely had 2 weeks ago, that's dissipated. Oil running to $200 a barrel, which was a real fear that people were starting to worry about, that's dissipated. The fear around the Fed all of a sudden having to do 100 basis point, a 1% rise, all of a sudden going full Paul Volcker on us, that has dissipated. And so it's not that we're free from all these future catalysts. It's not like we're have a clear runway to just take off, but the worst things that the market could be seeing, we're not. And so it makes sense that the market has risen. And it makes sense that we're not rising to the point where all of a sudden we're at all-time highs, because we still do have all these fear catalysts in the way. And speaking of, one of the decent news metrics, again, not maybe the best, but also something that we were looking at, is the jobs report for March. And first off, headline number, we rose 431,000, and the unemployment rate declined back to 3.6%, which is pretty low. If we look at this graph, the first graph that we see, it's what the unemployment rate was. So we were right around, that 3.7, 3.6, all of a sudden shot up above 14% in the pandemic. And look how fast we've recovered. Now, the fear about a really good jobs data is, wait a minute, we've been worried about the labor market overheating. How do we tell if the labor market is overheating? The way we tell is by wages. If anyone's going to look at the jobs report, the first thing that I recommend, skip all of this, scroll all the way down to, not that far, scroll all the way down to right here. And this is what matters. And I'm going to do this with you right here. So we're going to go calculator, and we're going to look it up right now. So we have 13 cents. So 0.13 divided by, if we look down, 31.73. So now you need to subtract the 13 cents because it's what it was in March. So 31.6 divided by 31.6 equals that. Now we want to multiply it by 100, and then we want to multiply it by 12, and the wage inflation, or the rate of wages going up, is 4.94%. That's a great number. The thing that we are so worried about with the Fed is that number, that 4.94%, is above what inflation is. Now, remember this. If the wage price spiral happens when wages are rising faster than inflation, what happens then is when wages are going up, people say, I got to spend my money right now. Spending more money right now raises inflation. Then costs of goods are more. All of a sudden, companies, in order to get top talent, have to pay more money. What then happens is people are making more money, start spending more money, then to continue to find the top talent. And all of a sudden we start spiraling like this, where inflation's going up, wages are going up. It's a nightmare. That's when the Fed comes in and says, all right, we're done with all of this, interest rates to the moon, we're done here. That's the biggest fear of the market. So the fact that we actually are seeing an annualized rate of wages come lower than what the annualized rate of inflation is a very strong indicator that we are still in an okay place. Now, if in the next couple months that reverses, we'll start being here a little bit more worried. Now, we'll say this again, a 5% wage inflation annualized, still relatively high, higher than what we would want to see, and the rate of inflation is still higher than what we want to see. So this is, again, coming back to that same thing that I was just talking about. Is it the worst news ever? No. Is it the best news ever? Also, no. And so the market is in this in-between place of, makes sense we're off the lows, and it makes sense we're not close to the highs right now.
So then it makes sense that the market really didn't do very much during these past week.
As long as we keep getting decent data and trending in the right direction, it wouldn't surprise me if we start to trend up more. If the data starts to come in more negative, we'll start to trend down. Big shocker there. So we are, at least for the next few weeks, potentially in this more quiet period of potentially some intraday volatility, intra-week volatility, but maybe a more stable market.
I hope you're right.
Well, as always, we appreciate you guys tuning in. We're here to support you. Your money's here to support you, and we'll see you again next week.